Hey everyone, welcome back to the compounding effect. Imagine this. You invest $10,000 in the stock market. One path costs you pennies and tracks the market's winners. The other promises to beat the market but charges you more, and often falls short. Did you know that over the past decade, a staggering 79% of active fund managers couldn't outperform simple index benchmarks? Today, we're breaking down active ETFs versus index ETFs to answer, is active management really worth the cost? Stick around because we'll use real market data, examples, and honest insights to help you decide. If you're new here, hit that subscribe button and turn on notifications. We're all about smart investing without the hype. What are ETFs and the key differences? First things first, let's make sure we're on the same page. ETFs, or exchange-traded funds, are like baskets of stocks, bonds, or other assets that you can buy and sell on the stock exchange, just like individual shares. They're super popular because they're flexible, tax-efficient, and often low cost. Now, the big divide is between index ETFs, also called passive, and active ETFs. Index ETFs aim to mirror a market index like the S&P 500, which tracks 500 of the largest U.S. companies. Think of them as autopilot investing. They buy what's in the index, no fancy picking required. Popular examples include the SPDRS and P500 ETF, SPY, from State Street, which has over $500 billion in assets, or Vanguard's Total Stock Market ETF, covering thousands of U.S. stocks. Active ETFs, on the other hand, have fund managers actively picking stocks to try and beat the market. They research, analyze, and adjust holdings based on trends like betting on tech disruptors or avoiding overvalued sectors. Examples: the ARK Innovation ETF, managed by Cathie Wood, focusing on innovative tech like Tesla and CRISPR, or the iShares U.S. Equity Factor Rotation Active ETF, DYNF, from BlackRock, which rotates between factors like value and growth. The big question: does that active expertise justify higher fees? Let's dive into the costs first. Section 1, the cost breakdown. Why fees matter. Costs are where index ETFs shine. The expense ratio is the annual fee you pay as a percentage of your investment, covering management, admin, and operations. Lower fees mean more money compounding in your pocket over time. For index ETFs, the asset-weighted average expense ratio in 2024 was just 0.14% for equity funds and 0.10% for bond funds, according to the Investment Company Institute. That's dirt cheap. Take SPY, its expense ratio is 0.0945%. Or Vanguard's VOO, another S&P 500 tracker, at a rock-bottom 0.03%. Over 10 years on a $10,000 investment growing at 7% annually, that 0.03% fee costs you about $40 total. Yeah, you heard that right. Less than a night out. Active ETFs, they average around 0.43% to 0.65% per Morningstar data from 2024 to 2025. ARKK charges 0.75%, while DYNF is at 0.30%. That might not sound like much, but let's crunch the numbers. On the same $10,000 at 7% growth over 10 years, a 0.75% fee eats up about $1,000. That's 25 times more than VOO. And remember, active funds often have higher trading costs inside the fund, which can add up. Why the difference? Active managers need teams for research and frequent trades, while index funds just follow a set recipe. But here's the honest truth. If active management consistently beats the market by enough to cover those fees, it could be worth it. So let's look at performance. Section 2, Performance Face-Off, real data and examples now. The meat of it. Does active deliver? The data is eye-opening and honestly not great for active most of the time. According to Morningstar's 2025 report, only 33% of active mutual funds and ETFs beat their average passive counterparts from July 2024 to June 2025. After fees. Over 10 years through June 2025, just 21% survived and outperformed. That's brutal, meaning 79% underperformed. U.S. large-cap stocks like the S&P 500, it's even worse. Active funds trailed passive 92% of the time over 15 years, per S&P's SPIVA report. Let's use real examples. Take the classic index ETF, SPY. From 2016 to 2025, roughly 10 years, its annualized return was about 12.8%, tracking the S&P 500 closely. That's after its tiny fee. Now compare to ARKK and Active Star. In 2020, ARKK exploded with a 157% return, crushing the market during the pandemic tech boom. But fast forward, in 2022, it plunged 67% as rates rose and growth stocks tanked. Over the past 5 years through late 2025, ARKK's annualized return is around 5.5%, way below SPY's 15% plus in the same period. Data from Morningstar and ETF.com. Another one, Vanguard's VTI index, total U.S. market, delivered about 12% annualized over 10 years. Compared to an active like the T. Rowe Price Blue Chip Growth, ETF, TCHP, which aims to beat large-cap growth indexes. It has outperformed in some years, like 2023, with 45% returns versus Russell 1000 gross 42%. But over longer periods, even T. Rowe Price's own study shows their active funds beat passives only 71% of the time in rolling 10-year periods, still leaving room for underperformance. In bonds, active sometimes edges out. For example, high-yield bond active funds beat passives 43% of the time over 10 years. The J.P. Morgan Beta Builders U.S. Aggregate Bond ETF, BBAG Index, has a 0.03% fee and about 1.5% annualized over 5 years. An active like the PIMCO Active Bond ETF charges 0.55% but has returned around 2.2% annualized, slightly better, but not always enough to justify the fee after taxes. Why do most active funds lag? Markets are efficient, and after fees, it's hard to consistently pick winners. Plus, active can be more volatile. Great in bull markets, painful in bears. But in niche areas like emerging markets or during volatility, like 2022's inflation spike, skilled active managers can shine by dodging risks. Section 3, Pros, Cons, and when active might be worth it. Quick recap, index ETFs pros, low fees, broad diversification, reliable market returns. Cons, they won't beat the market, they are the market. Active ETFs pros, flexibility to adapt, potential alpha in specific sectors. Cons, higher costs, higher risk of underperformance, more volatility. So is active worth it? For most everyday investors, no. Stick with index ETFs like SPY or VTI for core holdings. They've proven to build wealth steadily. But if you're in a tactical portfolio, believe in a manager's track record, check 10 plus years, or want exposure to themes like AI or clean energy, active could add value. Just diversify. Don't bet the farm. In the end, index ETFs usually win on cost and long-term performance for the average investor. Active management, it's rarely worth the extra bucks unless you're chasing specific edges. Thanks for watching. Drop a like if this helped. Comment your thoughts and subscribe for more no BS investing tips. See you next time.